been waiting for data, and we got a little bit because obviously the government is shut down. So this lack of information is really causing a little bit of discontent in the market. But some really good numbers came out this past week.
It did. So we finally got the September Consumer Price Index. And that's a really important number because it's used to calculate cost of living adjustments for Social Security benefits for 2026. And that actually came in. The Social Security Administration announced that that adjustment will be 2.8%. So I'm sure a lot of people are happy about that.
Especially when it comes to the raise that you're going to get for Social Security. And it's still within this margin of error that the Fed is looking for.
It is, because the overall inflation was about 3% year over year. Digging into the details of it, it gave me encouragement that we're actually going to see maybe inflation move lower going forward because services inflation has been slowing. So, the prices are still going up, just not as fast of a pace as before.
And we're going to have to watch that because we also got what's called a PMI number, and I don't want to get too wonky in all these economic data, but this is an important number. So 50 is kind of your Mendoza line, if you will.
That's right. So the Standard & Poor's, they go out and survey a bunch of businesses, the purchasing managers. So they develop this purchasing managers index. And these are people who have the finger on the pulse of what's going on with the businesses, and they ask, are things getting better or are they getting worse? And as you said, the 50 is that kind of line about if it's above 50, it means more of them than not
expansion.
Are saying, better. And if it's lower than that, then it's getting worse. So the services number came in at 55.2, which was a lot better than expected.
That's a good number.
That is.
I mean, it's significantly over that line. So that shows expansion. And that's probably coming out as well because I saw an expectation of GDP in 2026, and that's a big number as well.
That's right. So when we look at kind of forward-looking, which markets are forward-looking, that's what they do. Is it's great to see what the data was, but the market is pricing in what it expects data will be. So when we think ahead to 2026, what growth is likely to be, I think 2% is a reasonable run rate for this economy, and it actually looks like it's going to be better than that.
Yeah.
Now, obviously,
significantly, I saw in some of the numbers, because of all of the stimulus that's coming out, and there is a ton coming in 26 that I think you and I are the only ones talking about what's coming down the road. Obviously, the big, beautiful bill, all of those tax incentives are going to start coming out as people start to get some of the refunds back and all of the credits that are in this bill as well, the child care credit and the rest. That is good for the economy.
That's right. And it's not just households that are going to be getting some of these benefits in terms of, as you point out, like higher deductions, the child care credits.
But no tax on car interest. There's also an expansion of SALT and no tax on overtime.
That's right. And so we have all these things that are likely going to benefit consumers and therefore consumer spending, which, as you know, 70% of the economy is that. But when we think about the business incentives, we're already seeing early signs of that as far as with you can track the corporate tax payments to the government. And a lot of businesses, it looks like, are taking advantage of some of the incentives to invest for growth in property, plant, and equipment. That's already showing up in the data where the amount of money that they have to pay in for taxes for this year is actually going down. So you do have the push-pull, right? They have to pay some of the tariffs, but so far the net effect is that the corporate benefits from the one big beautiful bill are outweighing the cost of the tariffs.
And I want to come back to the tariffs, but you mentioned all of these expenditures, and so these are what are called CapEx or capital expenditures. If you hear the smart people talking, so CapEx is starting to improve, and they can do that in all of these things that you're talking about, including AI and the like. So look for that CapEx number to go on, which is good for spending for the economy. Also, you mentioned tariffs, and the Supreme Court is going to weigh in. It's not a matter if the tariffs will go through, it's how they will go through.
That's correct, because November 5th, I think, is when they're going to be hearing the arguments in court, and whether the Supreme Court strikes down the tariffs that were imposed under the power of IEEPA, so it's this International Emergency Economic Powers Act. Those are the broad-based ones that were used for kind of just everybody gets a tariff, kind of the Oprah Winfrey effect, right?
Everybody
gets one. And
look under the chair.
Even if that is struck down, the backup plan is to use other powers to implement it. Now, the reason why those weren't used to begin with, I think, were mostly the amount, the new, or I guess the more tried and true powers. The broad-based ones are capped at like 15%, but then they can do specific, like country-specific tariffs that could be a lot higher. So it's almost like they wanted to come out with more of a bang, and if they came out using the more traditional powers, it would have taken longer, or it wouldn't have maybe gotten people to the negotiating table quite as quickly.
And as we go into next week, the things that you should look for, at least newsworthy in regards to tariffs, are a relationship with Canada, ironically,
Yep.
and the relationship with China. And so with Canada, the Toronto Blue Jays are going to play the Los Angeles Dodgers. We'll see if there's some ramifications from that. Just kidding. Of course, folks, this is the time to go through your portfolio if you are managing the money yourself. If you want a second look at how we do it, there's a way to get that done.